Hi, my name's Toby Woods. I'm head of the UK and European Equities. I'm based in London and I'm a Brit. So you can imagine how smug I was turning up here at the beginning of last week after that game at Twickenham, only to go to Australia over the weekend and see my countrymen humiliated in another sporting encounter. So I'm sure there are a lot of comparables between sports and investing, but I'm not going to go there after that experience. Instead, I'm going to talk about Europe. Now, I've entitled my presentation "More Than Meets the Eye," and that's because when I talk to people about investing in Europe, I often get the sense that it is seen as a single, homogenous region with slow or no growth, weighed down by political issues, most recently in France, but also in the UK. In fact, the UK has a budget later today, so we'll see where that goes. But I think that is a little bit of a misperception. So what you've got on the screen in front of you is IMF growth forecasts of some selected European countries. And there's two things really to say about this. First one is the obvious, is that Europe is actually a very diverse place. The second one is that there is plenty of growth if you know where to look. So take Spain, for example. Spain is going to grow at almost 3% this year. That is double the rate of advanced economies as a whole. And it's closely followed by Ireland, Greece, Portugal. 10 years ago, these countries were mired in the European debt crisis. But thanks to some fiscal discipline, some structural reforms, some changes to labour markets, they have re-emerged stronger. And so we find some really good businesses and plenty of growth to look for in these regions. And in the Growth UK and Europe Fund, for instance, we have an overweight position in Spain. Just one last thing on this slide, and that's to go right down to the bottom to Germany, Europe's biggest economy. And it has been a laggard of growth and really pulled back the continent recently. But next year, it is set to grow again a little bit. And the reason for that is that Germany had elections earlier this year, and it resulted in a new coalition government and a new chancellor, Friedrich Merz. Now, it hasn't been all plain sailing for Friedrich Merz, but one of the first things he did was to release the so-called German debt brake. And he initiated an enormous, almost €1 trillion investment program aimed at infrastructure and defense. And this has been coined the German fiscal bazooka. As you can see on this chart, that is going to double investment in the economy over the next 5 years. But importantly, this is a 10-year program. And so that supplies a structural, not cyclical backdrop to growth that I think will permeate beyond infrastructure and defense and into sectors such as housing, transport, digitalization of the economy, climate, etc. What's great about this situation is that there's an excellent precedent. So we just have to look at Germany in the 1990s. So, as I'm sure you all know, the Berlin Wall came down in 1989, German reunification happened in 1990, and then soon after there was an investment program put in to bring East German infrastructure up to the same level as the West. And you can see how stark the outperformance of the German market was in the years that followed. So on the graph here, we've got the main German index, the DAX, in the white line, and below the main index of the US in orange, France in yellow, UK in blue, and Japan down the bottom in purple. So, if these policies are followed through in Germany properly, then there's definitely a situation like this can arise again. Given our bias towards Germany at the moment, I thought I'd just include a couple of case studies of some German companies that are held in the Growth UK and Europe Fund, and therefore by default also in the KiwiSaver products. So the first one is Vorwerk. This is a cable and pipeline company. It is classic infrastructure construction, if you like, of which Germany is actually in need of upgrading and expanding. What we like about this business is that it is doing well even before the German fiscal bazooka kicks in. So you can see here on the graph, the blue and orange lines are analyst expectations for earnings for this year and for next, and they have been consistently upgraded. This is what we want to see, and then that kind of takes the share price up with it, which you can see the green line. The next one is Pfister. This is relatively new to the German stock market. It listed in May earlier this year. This is what I describe as a typical picks and shovels play on the electrification industry. So it makes critical components such as insulators and connectors and stuff. You can see some examples on the screen. It has customers that are not only the grid operators, but also the cable manufacturers, and its customers are based throughout Europe, the Middle East, and India, all of which are growing really quite nicely. So again, here on the screen, you can see how well the share price has done. In fact, it's more than doubled since it listed about 6 months ago, and we've been in it from the get-go. I'm just going to finish on something which I think is often overlooked and underestimated, and that is capital flows. So literally the money that flows into and out of a certain market. What you've got here is data from the Investment Association in the UK, which is a trade body. And as you can see, in 8 out of the last 10 years, there has been pretty relentless outflows from European small cap funds, which is relevant for us. But it has been decreasing more recently. And if I was a betting man, which as an investor I am obviously not, I would bet that next year one of those bars would be green. And that's because anecdotally in London, I'm hearing more and more of my peers say that money is stopping going out and starting to come in. And history tells us that even a small shift in sentiment can drive modest inflows that can be really powerful for share prices. So when you combine that with some of the growth in the smaller regions, the German fiscal bazooka, I think Europe is actually far better set up than often the headlines lead us to believe. And with that, I think I'm going to get a grilling from Mike too.
Toby. I've always got so many questions for you, Toby, but I will limit it to 2 this evening because everyone else wants to hear from Michelle. All right. So the first one is that I listened to a podcast, great podcast on The Economist last week. They were interviewing Europe's top diplomat. Now, she was saying that Europe is becoming more united. Of course, Europe is not the United States of Europe, it's the European Union. And even though they're more united, they've got a bit of a bully on their border. And so, in the current situation, they might get cut out of the actual deal that's being done between Ukraine and Russia, orchestrated, I guess, by the US. So, how are we going to approach that as investors if the peace deal is done and Putin is right there again on the border?
Let's see. Let's see what happens, right, with this deal that Trump is trying to push through. And obviously, we hope for the end of any hostilities. But the fact of the matter is that Putin has proven that he cannot be trusted, and Europe has to get together and build up its defence. And a lot of NATO countries have now committed to at least 5% of their GDP on defence, and at least, say, 3.5% on what they call core defence. And that's coming from a really low base. A lot of countries were spending much less than 2%. So Europe is, rearming, and regardless of peace today or tomorrow or whatever, they will have to follow through that. And as sad as that is, dispassionately from a market point of view, that can actually be quite good for stock markets. So we have got a larger proportion of the fund into defence than we ordinarily would have, and by and large it's done well for us.
Okay. My next question is a little bit along the fiscal discipline theme. France, we all like to go on holiday to France. Did you actually know that France is the most visited country in the world? By quite a margin, over 100 million people. Anyway, so France recently had some issues politically, and part of that is because, they love a revolution over there, right? And so anytime there's something that they don't like, they're in the streets, on their tractors, driving through, protesting, they block motorways, they do whatever they can. So what they were protesting recently is they're trying to bring in some reform to raise the retirement age to 64. But of course, they got rejected because they were rioting. So it went back to 62. Things have calmed down now. Macron sorted it out. There's a new prime minister in place. But at some point, it's going to be a problem. If there's a big problem, like France, not just Greece, will the ECB, European Central Bank, bail them out?
I think the one way I'd answer that is probably yes. I think they'd have to. But you bring up a serious point, which is that France does have a pension problem predominantly, and therefore a debt problem to finance it. And it has been kicked down the road. But what I like about our investment approach into Europe is that we can be relatively nimble and we can move between these regions. So I don't know how France will ultimately fix its problems, but we can easily reduce our French exposure and increase our exposure to Spain, for instance, which is what we have done.
All right, that's sadly all we have time for. Thank you very much. We'll now welcome up Michelle.